Good morning. My name is Jay Kumar and I'm representing NTree International. Today I'm going to look at Basel III and its implications for banks holding gold. I've been seeing many economic commentators and blogs and articles claiming that Basel III will be bullish for gold. However, the problem here is that they're only considering one small segment of the picture. In reality, central banks and gold only make up 5% or even less than transactions. 95% of gold OTC transactions are settled through LBMA clearing members through London. This is known as local London. I'm going to start off with a quick introduction. What is Basel III? It's a set of international regulatory rules that look and focus on stress testing and liquidity of banks with their precious metal holdings. The main aim is to improve regulation, supervision, and risk management of the banks. It was actually originally agreed in November 2010, but due to complications and appeals, it's now set to be introduced in 1st of January 2022 for UK, and for Europe, it's set to be implemented soon on the 28th of June. The main reason that Basel III has been implemented is after the 2008 financial crisis, which I'm sure we can all remember, there was a need to also test and stress test and see liquidity for other markets, especially the gold and bullion market. They didn't really want a scenario where the gold market could crash or there is a liquid allocation of gold. So, again, like I said, the articles say they're bullish for gold, but this is really just for the central banks. And I'm going to go through their ideology and see what is happening. So, Basel III and central banks. What the Basel III regulation means for central banks is that gold is now being moved from a tier 3 asset to a tier 1 asset. What this essentially means is that with a tier 3 asset before Basel III, it meant gold had an RWA rating of 50%. RWA stands for risk-weighted assets. So this means that central banks with their physical reserves of gold on an allocated basis could only use half of that notional value on their balance sheets. Of course, this is terrible if you've got liabilities, greater liabilities, and you can only put half of that amount of money onto your assets, especially if you want to weigh up things equally. So now, the great thing for central banks is that the RWA has been given a rating of 0. This is good because now you get a 1-to-1 rating onto your balance sheet. If you have 500 million of gold, 500 million gold is going into your assets. This essentially means that gold is now been given a risk-free category for central banks, literally the same as cash. So as you can see on slide 3, I have a graph of central bank gold consumption. And if you see on 2018 and 2019, it actually hit 650 tons. This is the largest amount in 50 years. And it coincides with the announcement of Basel III for central banks, specifically in 2018. But the question here really is, yes, there has been increases in consumption in 2018 and 2019. But as you can see in the graph, expected consumption for 2021 almost halves. Will central banks really just change their whole physical reserves just because of this regulation? And also, we've seen in America, Basel III already been implemented with no real change in central physical gold reserves. So now I'm going to focus on Basel III and how it affects clearing members and market makers. So the main cause of interest we need to look at is called the net stable funding ratio, the NSFR. The ratio, as you can see, is on slide 4, and it is the available amounts of stable funding divided by the required amounts of stable funding. And this ratio needs to be greater than or equal to 100%. So what is the available amounts of stable funding, i.e. the ASF? So the ASF is essentially the amount of assets that the bank has, the amount of stable funding the bank has for more than a year. But this can include cash, capital, liabilities, again, with a maturity, a long-term maturity, which is defined as greater than a year. Now, the required stable funding, which is very important now for precious metals. Required stable funding is essentially the available stable funding that is needed to fund and provide liquidity to assets which during a stress scenario may not be able to get monetized and may be illiquid. So it ensures that banks can provide sufficient liquidity for their physical reserves and off-balance sheet commitments. So in summary, what is NSFR? It just ensures that long-term assets can be financed with long-term collateralization, allowing for liquidity and reducing risk. Now, for precious metals, the RSF must be 85%. This is a massive shock to the market, as before it was 0%. So this means that the regulation and Basel Committee deemed gold to actually be more risky than things such as exchange-traded equities, which have an RSF of 50%. So what does this RSF of 85% mean? As I just described earlier, it means that a physical allocated gold that banks hold must now be backed up with 85% of collateralization, which is likely to be cash given the fact it has an RSF of 0. Now, I've just made like a hypothetical explained example that I'll go through now, which you can see on slide 5. So let's just consider a clearing bank with an unallocated pool, of $5 billion. Of course, every clearing bank needs to back their unallocated holdings with allocated holdings, because you can convert your unallocated account to an allocated account to take physical delivery. So they can't be in a case where people want to take physical delivery of their gold and they can't commit and provide. So let's say, for example, this bank is holding 50% of physical allocated gold. So with the numbers I'm using, the unallocated holding is 5 billion. And so this would just be 2.5 billion. Nice and simple for now. And so they're using that to back the unallocated, as I said. Now, due to NSFR and specifically RSF of 85%, this bank is now going to need long-term cash of greater than a year to back up their physical inventory. And how are they going to do this? Well, they're going to just finance it and borrow it from other banks. What is the problem here? Well, the entire clearing and allocation system before has now been completely disrupted. Banks never had this problem. They could just back their physical gold without having to borrow this extra money. So again, consider this other hypothetical situation. Let's say the bank is charging its clients 10 basis points to put gold on an unallocated basis, but they need to borrow this long-term cash for 100 basis points. Clearly, there is a major problem here, and so much higher costs are being implemented. So what are the realistic solutions? Obviously, with basic economics, if it's a profit-maximizing firm and there's inelasticity, they would look to pass on these costs to their clients. But of course, this could have big exogenous shocks. For high cost of clients, this would go across the supply chain for miners, refiners, and consumers, and could destroy the gold market as we know it. Maybe consumers will use silver as an inflation hedge instead. And so secondly, that's not very realistic in my opinion. And actually, I know that the LBMA banks and clearing members are considering this. It's called a process of allocation. Simply put, let's say they have the unallocated holdings, they can actually force their clients to hold this gold now on an allocated basis. This completely eliminates NSFR because they don't need to hold this physical gold to back the unallocated holdings. They, in essence, pass the gold from their balance sheets onto the client's balance sheet. And they actually back this up. If you go onto the LPMCL website and look at their framework and terms and conditions, they write in a clause saying that they can enforce allocation when they want. Again, this will be good for the clearing bank, but have adverse costs for the clients and the sub-clients, as storing gold on an unallocated basis is cheaper than an allocated basis. Obviously, in general, the LBMA aren't very happy about Basel III. They want exemption, full exemption. But realistically, LBMA board members have been quoted saying they'll probably settle for 50% RSF. They provide evidence to show that gold is actually liquid and is stable in stress scenarios. They underwent their own correlation testing in which they did illiquidity ratios of gold, corporate bonds, and government bonds. So the higher the number, the higher the liquidity. The exact numbers are found on slide 6, I believe. And what they found out through their testing and regressions is that statistically economic significance shows that gold had a lower illiquidity ratio than corporate bonds and government bonds. Well, that's very surprising considering the fact corporate bonds have a RSF of only 15% and government bonds are deemed to be risk-free with only 0%. Furthermore, obviously with March 2020, when the pandemic was hitting its peak, due to lockdown measures and freights being grounded, there was a massive impact across all the markets. And they underwent statistics and they show that the FTSE lost $125 billion, whereas on the same day, daily trade volumes of gold were at $100 billion. So this shows that maybe it was very harsh to give an RSF of 85%. And lastly, to conclude, what are the possible consequences? So maybe there'll be none. Maybe there will be full exemption. NSFR is overturned, and this whole Basel III palaver for gold is over. However, like I said, this is very unlikely. This framework has been implemented and put into place since 2010. Next, the foreclosure of bullion clearing banks and market makers. Profit margins just might not be profitable anymore, so clearing members may just leave the precious metals industry altogether. An example of this maybe could be Nova Scotia. They're leaving the precious metals industry, and Basel III could have played a major role. Thirdly, like I mentioned, higher clearing and settlement costs. This could be passed on to the consumers and clients, which would do an exogenous shock across the whole supply chain. Miners at higher cost, refiners and consumers. And again, like I mentioned before, these economic agents could leave the market along with market makers, and there will be a massive fall in liquidity, increasing spreads, which would be disastrous. And finally, there could be this mitigation through allocation, which I believe personally will happen if the Basel III is implemented. So just to conclude, economic commentators say it's bullish for gold, but they're not considering the entire picture. It might be slightly bullish in the short run for central banks, but we need to look at London OTC markets, where 25 billion in transactions are handled on a constant basis. And that concludes my presentation. Thank you very much for tuning in, and I hope it was informative on Basel III and its consequences.